Next section is section 49.1. Now look here. In section 49.1, you will find a situation where there will be two transfers. In the question, there will be two transfers. Look at the drawing. First transfer will be exempt under section 47. Means it will be which type of transfer? Gift, will, inheritance, partition, conversion, amalgamation, holding subsidiary, exchange. Remember that list? So first they will give a transaction from 47 list. And there, as I said, capital gains is not computed. So it will be exempt. Okay. But immediately after the first transfer, there will be one more transfer which will be a regular sale. Which will be a regular sale. In that, capital gains will come. But how it will come? For that, there is section 49.1. So, 49.1 is for what? For sale immediately after exempt transfer. See, what is the heading I have given? Capital gain after exempt transfer. So, see, first there will be exempt transfer and afterwards there will be normal sale. There you will have to calculate capital gains in a special manner. So what is so special I will tell you, but this is 49.1. Okay. So I will do one thing. I will take one example. I will take one example of section 47 transfer and then I will take a back-to-back sale to explain the concept. See the next slide. Look at this example. Read and understand what is given. Can you see? First transaction is between holding and subsidiary company and that to 100% subsidiary company. So it is a transfer exempt under section 47. I told you that only, na? First transfer will be from 47. So did you see it is from 47? But let me clarify this explanation. I am just taking holding subsidiary as an example. Don't by heart that sir is teaching something special for holding subsidiary. Holding subsidiary is just an example. If you want, I can change the example. I can take anything from section 47 list. So just for convenience, I have taken one example of holding subsidiary. Okay, now, assume holding company purchased the land in 17-18 at a cost of 100 and it was sold in 21-22 for 400 rupees. And later on, the same land was sold by subsidiary further in 24-25 at a sale price of 500. Now tell me, here capital gains will not come, but here it will come or not. How will it come? Calculate. I want you to calculate capital gains for this. Imagine you are the subsidiary and if you sell the land, what is the capital gain on which you will pay the tax? Yes, so normally what you will think, subsidiary has sold the land for 500, so 500 is the sale price. And for subsidiary, the land at cost how much? 400. See, 400 was the sale price in this transaction. But for subsidiary, it's a purchase. It had cost him 400 and the same thing it has sold for 500. So it looks like capital gains is 100, correct? Look here. Sale price will come in FOC and this cost will come in COA. So accordingly capital gains will be 100. But it is not like this. See, naturally you will take 100 as the cost. Why? Because subsidiary got the land for a price of 100 and you get the land for 400, price of 400. So for you it's the cost. But I will not take this as the cost. I will take 100 as the cost. And this will be the capital gains. This. Why? This is written in section 49.1. Huh? Section 49.1 says cost will be taken not from the current owner. It will be taken from the previous owner. See, read what I have written. Read. What is this? CEO means current owner. Who is currently the owner? Subsidiary. Holding was the owner earlier. So holding is called previous owner. So what section 49(1) says, cost will not be taken from the current owner. It will be taken from the previous owner. Why? See, it is looking weird. Actually, I am calculating capital gain for the current owner. The current owner subsidiary is the seller. It's the profit maker. But I am taking the cost not from the current owner. I am taking from the previous owner. Why? Basically, what government is feeling, when this transaction happened, the land of 100, which was sold for 400, government did not tax the difference of 300. It was exempt. So that exemption government is withdrawing. Government gave the exemption earlier. Why? Because government felt holding giving to subsidiary, the land is with you only. It's one and the same. Holding and subsidiary, they are one and the same. So the land is with us only. Yes, in the eyes of law, it looks like no, it was withholding, it went to subsidiary. But the inside thing is what? We know the land is with us only. So government did not feel proper to tax you. So that's why at that moment it was exempt. But now the land has gone out. Now can you say the land is with us only, land is with us only? No, it has gone out. And once the land has gone out, the gain is realized. Up till here, the gain was unrealized. Have you heard in accounts realized gain, unrealized? See, till the time the land was with us only, so the gain was unrealized. Yes, the land appreciated from 100 to 400. But since the land was with subsidiary, which is as good as my company only, so I felt the gain is not realized. So that's why government also didn't tax. But now since the land has gone out, the gain is realized and now government will tax the entire gain. Entire means 500 minus 400. And in this process, what is happening, this thing which was exempted, even this is becoming taxable. And even this is becoming taxable. Both the gains are taxed together in one shot. In short, section 47 fooled us. It created an impression. What impression? That government is so generous. Although we have the basis to charge, we will not charge you. See, in 47, what impression was created? There is a capital asset, there is a transfer, but still government will not tax us. So we felt government is so nice. They are so good people. It is so generous. But they fooled us. This exemption was temporary. Why I am saying temporary? Because the moment that land is sold later on, government will tax you on the entire gain, including the one which was exempted earlier. So this is the strategy of government. See, basically in 47, government felt it's not proper to tax because either someone is not intending to make profit or the asset is with you only. It's not a real transfer. So government felt inappropriate to tax you. But at that time, but once the land has gone out by a normal sale, then government will tax you fully. Fully means they will tax this amount also and previous amount also. That's why they are taking the cost from the previous owner. So this is 49(1). Okay. So 47 is a permanent exemption or temporary? Temporary. It is for the timing exempt, but once you sell the property later on, the whole difference will be taxable. In one way, you can say the exemption is withdrawn. You understand this language? See, in this transaction, exemption was granted. How to say? The exemption was granted. But once the sale happens at a later date, the exemption is withdrawn, means the exemption becomes taxable because we take this cost and this sale price. Now tell me, since I have taken the cost from holding company, how will you decide a period, short and long? See, generally, if subsidiary company is selling, So generally the period should be counted like this. Subsidiary got the land in 21-22, it sold the land in 24-25. This is the way you should count the period. Like if I am a subsidiary, I will think like this only. I got in 21, I sold in 24. So I will count like that. But no, since the cost is taken from the previous owner, the period will also start from the previous owner. Since you have to measure from 17-18 to 24-25. See, I am discussing how to decide short long. See, in my example, whether you calculate from 21-22 or you calculate from 17-18 doesn't make any difference. But sometimes the question is framed in such a way that it can change your answer. So what is the right way to decide short long? Previous owner. Now tell me, from 17-18 if you count, it is short or long? Tell me, it is long. And in long-term capital gains, you do indexation, provided if the sale is before budget. It is long-term or not? Some students are not, this is long-term or not? Long-term. And in long-term, we do indexation, provided a sale is before budget. So see here, sale happened in 24-25. Let's assume it happened before budget, before 23rd July 25, 24. Then indexation will be done. How? Do the indexation. Cost into index upon index. Upper transfer, niche purchase. Give the index. 100 is the cost into index for 24-25, 363. Divide by index for 17-18. Search and tell me. Index for 17-18 is how much? 272. Anyways, index will be given in the question. See, I have done here. Have I done it correctly? See, this way indexation will be done. Okay. Now look here. Look. Tell me, index in the numerator I have taken for 24-25. In the denominator, I have taken the index from 17-18, previous owner. So this means what, everything you have to take from previous owner. So see, moral of the story. Look, this is the moral of the story. Read. There are three important things which a student should note. When you take the cost, take it from the previous owner. When you take the period, take it from the previous owner. When you take the index, take it from the previous owner. CPI. I call such sums as CPI sums. Say CPI sums. PO, PO, PO. What is this PO, PO, PO? Previous owner, previous owner, previous owner. Actually, these are the three important points a student should note. Cost from the previous owner. See, earlier you told me you will take 400 as a cost. But that was wrong. Cost from the previous owner. Period from the previous owner. Index from the previous owner. Everything from the previous owner. Whenever the previous transaction is exempt under 47. See the way of remembering. Whenever the previous transaction is exempt under 47, I will take the cost, period, index from the previous owner. But whenever the previous transaction is exempt under 47, and how will you come to know it's exempt under 47? Remember the list of 47, that list of 7 points I have given, okay? Now tell me one more point. What if there is improvement here? Imagine holding company, see, generally in land, there will be no improvement. But forget it's a land. In general, tell me, if holding company has done some improvement and then it sold to subsidiary and subsidiary also did some improvement. Means what I'm trying to say in the question, there are two improvements. One improvement done by the previous owner, other done by the current owner. So which one you will take? Both. Because since we are taking the previous owner as the base, so even this will be covered, this will be covered. See, it is simple, but it's better to clarify because suddenly if it comes in question, you will be stuck up. So remember this point also, in such questions, if previous owner has done some improvement, current owner has done improvement, take both improvement in the deduction. Okay. Improvement comes in index kavva, kavvi, kavvi, kavvi. Okay. I am repeating the same thing with a different example. Here I took holding subsidiary example of section 47. Now I am taking some different example, but you will find sir is repeating the same thing. But please have patience. For some time you will feel I am repeating the same thing again, but then you will find some good point. But to understand that good point, first you will have to bear some repetition. See, look at this example and explain based on what I have taught. You will find everything same. The only change is here I have taken gift as the example. In the previous example, it was holding subsidiary. But whether holding subsidiary or gift, both fall in the list of 47. You remember the list of 47? Gift, will, inheritance, partition, conversion, amalgamation, son, holding subsidiary, exchange. So only thing is here it was holding subsidiary. Now I am taking example of gift. Okay. So tell me what will you do? Understand the example. This is a very good example now. Assume X had purchased a land for 100 at a cost of 100 in 1718. He gifted to Y in 2122 at a fair market value of, means at the time of gift the market value was 400. Gift is for free, but at that time the market value was 400. And then the same land is sold by Y to Z in 2425. See, I purposely kept the figures also same. But the change is previous example was holding subsidiary, now it is gift. So tell me what will you do? First, in this transaction, capital gains will come or not? No. Why it is exempt? You remember the logic of this? I told you, you might have love and affection with the other party. You gifted for free. But we don't have love and affection. For us, the land was of 100. It has appreciated to 400. We want tax. Government, if they wanted, they could have taxed you. They have the basis to charge you. But still government did not tax. Thinking what? The person who is gifting does not have motive to make gain. So that's why they exempted. Remember that example? So whatever it was exempt. Now what Y has done? He has sold. Now tell me how capital gains will come. This will be my FEOC. And what will be my Kawwa? 400 or the previous owner's cost. Previous owner's cost will be Kawwa. That's what I explained in the previous example. That whenever the previous transaction is exempt under 47, take the cost of the previous owner. Okay, this is the way you will do. So look here. I have done correctly. I have taken 500 as the FEOC, cost as 100. But you know, sometimes under income from other sources, gift is taxed. I'm saying sometimes because under income from other source, I am Dr. LC is exempt. Remember the keyword of I am Dr. LC, certain gifts are exempt, but sometimes it is taxable. And why again I'm saying sometimes only if the value exceeds 50,000. In gift, remember I gave 50,000 amount, up to 50,000 exempt, but above 50,000 taxable. So tell me, what if this land was taxed under EFOS? You know, EFOS is for the gifter or the receiver. Here, who is the receiver? Y is the receiver. So think from Y's point of view. When Y received the gift, he might have paid tax. See, might have means, you know why? Because if it is a marriage gift, it's exempt. If the gift is from relative, it's exempt. But let's assume X and Y are just friends. They are just friends. And between friends, if there's gifting above 50,000 taxable, and assume the amounts are above 50,000, all the amounts are in thousands. Consider this 400 is 400,000, means 4 lakhs. So tell me, if Y has received the gift from his friend, so he might have paid tax on, you know, in income from other source, when you receive the gift, you pay tax on the market value. Remember or not, I told you, you pay tax on the market value. So what is the market value of gift item? 400. So why will have to pay tax under EFOS? And if Y has already paid tax under EFOS, then we will take only this difference in capital gains. Then don't take cost from the previous owner. Take it from the current owner only. Why? Because he has already paid the tax. Tell me, what is the logic of taking from the previous owner? Because previous transaction was tax free. Still it is tax free, but in capital gain it's tax free. But in EFOS, it is taxed. So whether under capital gain or EFOS, if it is taxed somewhere, so it is taxed. So government should forget it now. So now government can tax only this difference. This is written in 49.4. You know what 40? First I explained the 49.1. 49.1 says take it from previous owner, take it from previous owner, take it from previous owner. Now what 49.4 says? Beware, beware, beware. If the receiver of the gift has been taxed under EFOS, then don't go to the previous owner. Then only current owner's cost will be taken as the base. Means you know what will happen? 500 will be FVOC. 400 will become Kawa. Because 400 is already taxed under EFOS. But you know, that is if he is taxed under EFOS. And it's not necessary that you will have to pay tax under EFOS. Like imagine X and Y are father son. Father and son are relative. And amongst relative, if there is gifting, there is no tax. So tell me, if X and Y are relative, that means on this 400, did Y pay tax? No, it is exempt in EFOS. Then this transaction was completely tax free. Exempt under capital gain also, exempt in EFOS also, and if it is completely exempt, then government will take previous owner. Actually, this tricky thing can happen in gift only, huh? Because gift is dicey. It may be taxed in EFOS, it may not be. And whether it is taxed in EFOS or not, for that please revise EFOS and come. In at least you remember there was I am doctor, like, okay, tell me, I am doctor, what was a marriage? So tell me, if this land was gifted by X to Y a marriage, so it is exempt. If it is exempt, then you know what you should feel? Then this transaction was completely tax free. Neither taxed under, see, capital gains is always not taxed. But capital gains is for the gifter, for the transferor. But for the receiver, EFOS may or may not come. But if I am saying it's marriage, so EFOS will not come. So that means the transaction becomes completely tax free, neither tax under CG nor under EFOS, then from the previous owner. And when we take previous owner, 49.1. You should say 49.1. But if Y has been taxed under EFOS, then you will take 49.4. Okay. And in such case, you know, I say cost, period, index, everything should be taken from current owner. See, here I said PO, PO, PO. Now it will be CO, CO, CO. Here what was the code? PO, PO, PO. PO means previous owner. But if that person has been taxed under EFOS, then PO, PO, PO or CO, CO, CO. Means everything you will take from current owner. Means this will become the base. And this transaction will be completely ignored. And government is satisfied with the transaction, huh? Because they have already got the tax. So see, I have written here both the things. Tell me why I have written both the things, you know. Because anything can happen. That you have to notice in the question. What will you check? Whether Y was taxed under EFOS or not. That depends upon the question. Say here orally I can change anything. But in the actual question they will mention. And in the question if you feel, oh, Y was taxed under EFOS, then you will take 400 as the base. But if in the question you see he was not taxed, then you will take 100 as the base. So see, I have written both the things. Now see, I have made a good chart over here. Tell me, when to take 100, or you can say when to take previous owner if it was not charged in EFOS. We want it should be completely free. So see, I have written EFOS cross. Can you see the cross mark? Then you will take PO, PO, PO. And when you take previous owner, the section becomes 49.1. Okay. Now tell me when to take 400 if Y is taxed under EFOS. So see, I have written here. EFOS tick means what? Taxed under EFOS. And then see, have I written PO, PO, PO or CO, CO, CO? CO, 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 current owner. And the relevant section will be 14 and 4. Okay. So I have completed two sections, 14 and 1, 14 and 4. Tell me, in this example, tell me, to explain 14 and 4, why I had to take one more example with the help of holding subsidiary. Why didn't I explain that 14 and 4? Because in holding subsidiary, there is nothing like EFOS. See, because holding subsidiary thing, you will be always exempt. Always. Gift was controversial. Gift may or may not get taxed. That's why, after explaining this example, I had to take one more example. My idea was what, if I take the example of gift, I can explain that point also. Which point? That if gift is taxed under EFOS, then you will take 49.4. Okay. Means you will take only small difference. Okay. From the current owner. This is done now. One more thing, look. Now in my next explanation, please assume Y was not taxed under EFOS. Means X and Y are brother sister. And between brother and sister, if there is gifting, there is no tax. Relatives. So let's assume Y did not pay the tax under EFOS. So what will do? Answer, I want to explain one point. Then you will take the cost of the previous owner. But previous owner also got the land in gift. Just as Y got under gift, so we ignored Y and went to X. But X is saying, I also got gift. So ignore X, go before X. And that before person says, I also got gift. Ignore that, go before. Yes, look here. This situation I have explained. What I am trying to say, I have drawn here. So tell me here what has happened. A gifted to B, B gifted to X, X to Y, and then eventually Y sold. So as long as gifting was happening, it was exempt, exempt, exempt under section 47. Gift is exempt under section 47. But 47 is exempting the gifter. And I am assuming the receiver was also exempted. So tell me now, when Y sells the land, you will take this as the FEOC. Which one? And cost will be taken from the last previous owner. You will take the cost from A. Because see, whenever there was gifting, every time the asset was appreciating or not. Like see, originally asset was of 100. Then it appreciated to 120. Then the value appreciated to 145. Then it value appreciated to 150. So every time it was appreciated, look, it was being exempt. It was being exempt. So government is hungry now. Because government did not get the food of tax. Every time exempt. It became 100 to 120. We didn't get tax. We were empty stomach. Then when it became 120 to 145, again empty stomach. And then 145 to 1, again empty stomach. So now government's hunger is increasing. Now when Y sells for say 200, so government will tax full amount. Because all the previous appreciations were exempt. And in that exempt, government was actually fasting. Fasting is they were not getting the food of tax. And then Why made a profit of 50 only? But government is so hungry that it will take tax on 50 or entire amount. Entire amount. Because see, every time there was exemption, government did not get the tax. Now they want the tax right from the beginning. In short, see, in the law they have written, previous owner means the last previous owner. Actually, law has written this much only. But a student will not understand. That's why I framed an example. See, this is not my word, sir. Can you see last previous owner? It is written in the act. Previous owner means the last previous owner. So to explain the concept of last previous owner, I took such example. But let me tell you, in exam they will not give such lengthy thing. In exam, this will be the situation which I discussed. Trust me. They will give you this plain vanilla situation. Plain vanilla. They will not give a cocktail situation like this. Okay. But at least you should have the knowledge that in case there are multiple gifting, you will take the last previous owner. Okay, let me see if you understood. See. A gifted to B, it was exam under EFOS and CG both. But you know, when B gifted to X, both are not related. They are friends, just friends. Boyfriend, girlfriend, okay? Just friends. Just friends, okay? So tell me, now they are not relatives. They are not married yet. After marriage, spouse becomes a relative. So they are not relative. So if non-relative, then receiver has to pay tax. Who is the receiver? X. So he has paid the tax under EFOS. And once the tax has been levied, that becomes the base. Then cost will be taken from X to the ultimate sale price. In short, if you understood the concept, whatever they twist, you will be able to answer. But trust me, they will not give you such complicated situation. They will give you a plain vanilla situation like this, okay? Immediately, it's necessary for us to take one question, so that we understand how to actually do this thing. Okay, see, look, his doubt is what, in real life, how we will come to know all this. See, the situation which I gave, I am literally telling you like a story. So when the story is told, everything is revealed. But in real life, we sit at our home, income tax officer at their home, at their office. How will they come to know that happened in my life? So naturally, they don't come to know. They expect us to reveal honestly. They expect us to reveal that this happened honestly. But if we don't reveal, obviously government will not come to know. But if government wants to find out, they can find out anything in income tax scrutiny. There is something called income tax scrutiny. Scrutiny means detailed investigation. How that happens, all that we'll study in CA final. But in general, it's very difficult for government to know. And if a person is not honest, he will not say anything. He will always lie. And if it is not known to government, enjoy the benefits of lie. But if government wants to know, they can find out anything. Okay. But anyway, students' lookout is not how government will come to know. We are not studying how to fool. We are studying the rule. As a rule, this is the provision. If government doesn't come to know, if you want to fool, you fool. Question number 13. Before I take that sum, here what did I say? If Y has paid the tax under EFOS, then he should pay tax on 400 rupees. Then we take only this difference in capital gains, correct? But in this example, there is some defect. Let me see whether you can catch the defect. Means I've taught everything right, don't worry. But technically, there is some defect which you can point out. Yes, you should say, sir, why have you written FMB? Because we remember income from others was very well. In EFOS, you told us that when immovable property is received as gift, we see stamp duty value per property. Remember? Based on HDB, we decide 50,000 more than 50,000 or not? So since land is immovable property, so technically I should not have given FMV. I should have given here SDV. That's okay. This was just casual. But in the actual question which is framed in the paper, this 400 will be given to you as SDV. If it is a question on immovable property. Yes, if instead of land it is gold, silver, movable, then it is the FMV. See, I'm trying to connect with EFOS. I don't know whether you remember the EFOS or not. So, anyways, everything we have studied is proper. It is just FMV will be given in the question if it is a movable item. For immovable item, they will give HDV. But that's okay. The answer remains like this only. So see in this question how we have given. This is a proper framed question. Read. Sujoy purchased a flat on 12th August 2011 for 75 lakhs. Brokerage 2%. What will happen to brokerage? See, generally listening to the brokerage, your immediate instinct is transfer expense. But transfer expense is when you pay brokerage on transfer at the time of sale. But this is brokerage at the time of sale or at the time of purchase. This is while purchasing you paid the brokerage. Add it to the cost. Add to the cost. If brokerage is incurred at the time of sale, then transfer expense. But this is at the time of purchase, so add to the cost. So my effective cost is what? 75 lakhs plus 2%, it comes to 76 lakh 50,000. Then read, on 9th July 2018, he gifted this flat to Ajay. Sujoy gifted to Ajay. Then this flat is subsequently sold by Ajay for 1 crore 30 lakhs on 6th June 2024. This is the transfer date. Do one thing. Right here, transfer date. Tell me in these sums of capital gains, transfer date is important or not? To decide short term, long term, we measure from purchase date to transfer date. For indexation also, ऊपर transfer नीचे purchase. And to decide whether to apply old rule before budget or new rule, we have to see transfer date. So this date will be helpful for that. And since it is before budget, 6th June is before 20, what was the budget date? 23rd July 24. So it's before, so indexation, everything will be done. Huh? We will go as per the rule before budget. Then stamp duty value of the flat as on 9th June 2018. So 9 July. What is 9 July? What is that date? Gift date. Read this. What happened on 9th July? Gifting. And on the date of gifting, 98 lakhs was the stamp duty value. See, in the paragraph form they have messed up. You know, this will become a very simple question if you draw the drawing. In exam, drawing is not necessary. But right now, I want to explain you in the best manner. So, we will do the drawing. But in exam, you can mentally think and do. What drawing I am saying? This drawing. I want you to draw like this. Tell me in our example, who is X, who is Y? Sujoy, Ajay, and then sold. So the way I have drawn this, you also try to draw from the given facts of the question. I will show you how to draw, but you try. This is the question. First draw like this. Sujoy gifted to Ajay. Then Ajay sold. And in this drawing, the very first person is the previous owner. And the middle one is the current owner. Then see the data. Tell me, how did I get these dates? In the question they are given, when did Sujoy purchase? Read 12th August 2011. So this is which financial year? 11-12. See, you can write the date also, but I am writing financial year 11-12. Everything is given in the question. You have to just convert into drawing. And you don't have to be a great artist for this. Simple drawing. Tell me, when did Sujoy gift to Ajay? 9th July 18. So 9th July 18 means 1819. This is the year when gift was given. And the ultimate sale happened on 24-25 means 6th June. What was it? 6th June 24. Then amounts also. Sujoy purchased in 11-12 at what price? Actually, it was for 75 lakhs, but including brokerage, it becomes 76 lakhs 50,000, correct? Then this stamp duty value, do you find in the question? See what was given. Stamp duty value is on which date? 9th July 18. That is the date of gift. So see, I have rightly written. When Ajay got the gift in 1819, at that time stamp duty value was 98 lakhs. It is the same which was rupees 400 in my example. And the final sale is at 1 crore 30 lakhs. Even that was given. See, check in the question, it was given 1 crore 30 lakhs. And then write like this. Write like this. This transaction is exempt under 47. And then subsequent sale will be taxable. Okay, now read what is asked in the question. Please read. Compute the amount of capital gains assuming Sujoy and Ajay are brothers. So if they are brothers, it becomes a relative. And relative gift is exempt in ESOPS. But if they are friends, then ESOPS tax will come. See, in any case, for the gifter, capital gain will not come. Because for the gifter, he didn't have the motive to gain. So, gifter is always exempt under 47(1). The position of receiver will change. Okay. So, see, answer will be presented in two parts. Wait, do one thing. Look here, look. Tell me, what if they are brothers? What if Sujoy and Ajay are brothers? Brothers means it is totally tax free. If tax will not come, then I will take from previous owner. Correct or not? So see what I am doing. Then I will take from previous owner. When? If they are brothers. You can also do like this. If they are brothers, correct. Then tell me, if Sujoy and Ajay are friends, then on this ESOPS tax will come. Then we will take from Ajay to sale. Okay. See, in my Hindi batch I say Bada Chand, Chota Chand. Chand means moon. See, this is Bada Chand. Bada means big. Big moon. Bada Chand. When to take Bada Chand? If there is no ESOPS tension, nothing is taxed, so Bada Chand. But if they are friends, then ESOPS tax will come. Then Chota Chand. Chota Chand means small moon. Okay. See, my Chand is so accurate. See. And this is when they are friends. Actually, this drawing is not needed in exam. This is for our understanding. So see, right now, main answer. Now comes the main answer. Assumption 1, Sujoy and Ajay are brothers. So see, first full value consideration will be what? Sale price, 1 crore 30 lakhs. See, brothers means this scene you have to visualize. Huh? Bada Chand, big moon. See, the answer should be like this. Indexed Kawa. Why indexed? Because it is long term. And you counted the period based on Bada Chand. Huh? From 11-12 to 24-25, the period is long. And that also I have done the indexation because the transfer is before budget. Cost into index upon index, upper transfer, niche purchase. So, upper in the numerator 24-25 index. Niche in the denominator 11-12 index. And mention here cost of previous owner as per section 14 and 1. See, you took cost from the previous owner, no? So you have to show that I have taken the cost from the previous owner as per section 49(1). See, when you take Bada Chand, it's 49(1). And when you take Chota Chand, 49(4). Getting long-term loss. Then same working, but now I will take, look here, cost from previous owner or from the current owner. Current owner. Only this thing will change. And if the cost will change, the index in the denominator will also change. Because now I am going as per Chota Chand approach. So see, next what I have written. Sujoy and Ajay are friends. Just friends. Here I have taken 98 lakhs. 98 lakhs was the center value in our drawing, the middle value, middle in the drawing. 98 lakhs. Current owner's value. Okay, now look here. Check the status of the sections. Look here. We did 47 last. We did 49(1). We did 49(4) also. But see, 49(4) is applicable only in gift situation. And that too taxed under ESOPS. But 49(1) is applicable always. Anything from 47 exempt transfers list comes, whether holding subsidiary, amalgamation, that HUF partition, every situation 49(1) is applicable. But 49(4) is restricted to gift, which is taxed under ESOPS. Let's see, next section is what? 49(2)AA. Now this is different. See, I was saying there is some combo kind of thing, remember? But that combo was of these three sections only. In the sense they were connected. Now now we are independent. Huh? Next section is what? 49(2)AA. Do you know what is ESOPS? Employees stock. OP means option scheme. So tell me, under ESOPS what happened? The employees are allotted shares by the company at a lower price. So let's assume you are working in some company and the fair market value of the company share is 100 rupees. And since you are employee, for you the issue price is 20 rupees. What is IP? Issue price. Tell me, fair market value is 100, but why you have to pay only 20? Because you are employee. So this is the benefit. And since you are getting the benefit because of you being an employee, it is part of your salary income. It's a perquisite. It will be taxable. What amount will be taxable? 80 rupees. This I taught you in salary. Perquisite, my keyword was come light. And my spelling of come light was CUMLIEGHT. In LIEGHT, what was E? ESOPS. Remember or not? So in short, when employees are allotted the shares under ESOPs, the difference is taxable under income from salary. Perquisite. Now comes the main point. Look, let's assume this happened in 2019-20. Now, in 24-25, what happened? Look, in 24-25, these ESOPs shares were sold for rupees 500. It was sold in 24-25. So now tell me, when you sell shares, it is sale of shares. Shares are capital asset, sale is a transfer, so capital gains will arise. How do you get the hint of capital gains? Capital asset plus transfer. So shares are capital asset, sale is a transfer, so capital gains. How will you calculate? Calculate. See, when I say how to calculate means don't wander here and there. FEOC, start full value of consideration. Very good. So this is the FEOC. Then cost of acquisition. Actually the cost is 20. Because cost means what you paid. Tell me, as an employee, what you paid for the shares? 20. So if someone tells you how much you paid, I paid 20. And what you paid is your cost. But we will not take this as the cost. We will take 100 as the kawwa. as per 49(2)(a). This will be the cost and this will be the capital gain. You know why? Because this amount has already been taxed under the head income from salary. And imagine if government says, no, no, we will take 20 as the cost because you paid 20 and what you pay is the cost. So imagine if 20 is taken as the cost, there will be double tax because from 20 to 100, I have already paid the tax. So that should be ignored now. So to clarify this point, there is a section. You know, if this section was not there, income tax officers are sometimes working brainless. You know what they say? Cost means cost. How much you paid? You paid 20, that's your cost. He will take 20 as the cost. They don't think logically. Sometimes they behave very illogically. They will stick to one thing. Cost means cost. How much you paid? 20. So they will take 20 as my cost. So that will amount to double tax. People will suffer. That's why government has kept one section so that people will be safe. Every person who has already suffered tax on 80, he should be protected now. And to protect him, what law says? Since this 80 is already taxed, now the further capital gain will be based on 100 and 500. That's it. This is 49(2)(a). One more thing. You know, when ESOPs come in real life, ESOP doesn't get over in one day. It remains open for some period. So during the period the ESOPs is active, the FMV keeps fluctuating. Do you know something about ESOPs, Employee Stock Option Scheme? The scheme doesn't come in one day, get finished in one day. Company will make an announcement. And then employees will think whether they want to buy the share or not. So the scheme is alive for some period. And during the period, FMV fluctuates. Which FMV should I take here? See, company might have announced the ESOPs on 9th June. An employee might have decided and told the company on 7th September. So there is a long period. So which day's FMV is important? The date of announcing if ESOPs? No. The date when employee exercises his option. And to exercise the option, you might have to fill a form. You have to fill a form and tell company that I want the shares. See, employee has to exercise the option because it's not free shares. Although it is given at a lower price, but he has to pay. So we give him a chance to think. And once he has decided, once he says, yes, I want the shares. So that is the date when he has exercised the option. That day, FMV should be taken. In short, if the question is tough, you know what they will do? They will give 2-3 FMVs. FMV on this day, FMV on this day, FMV on that day. Various FMVs will be given. So you will take FMV of which day? Date of exercising the option. Okay. Anyways, if the question is simple, they will simply give one FMV. Take that. Okay. 49(2)(a) is done. Next, try this. See, my plan is what you know. Once you try this example, I can explain 2 sections in one shot. My next target is 48 and 50. But that I can successfully explain only if you help me give the answer of this. Please help me. Solve this sum. My target section is 48 and 50 now. But that target can be achieved only if you try this. Okay, tell me the answer orally. Start from the start. First, full value of consideration. How much? 28 lakhs. Then transfer expense is not there. Then less kavva or index kavva. Why? Because it is long term. And we are assuming it is before budget. So index kavva. So how will you do? Cost into index upon index, upper transfer, niche purchase. What is the cost? 12 lakhs. Into index upon index, upper transfer, niche purchase. That is wrong. You nicely started using this format, but this is wrong because you didn't notice Factory building is a depreciable asset. Depreciable assets are governed by block. You have to make opening WDV, add, purchase, less sale, and then we sing a song. All sold, some sold, positive, negative, satak loss, satak G, depreciation, satak G. So in this song there is satak G and all. So whenever there is a depreciable asset, first tell me how did I know it's a depreciable asset? Factory building, a building where there is a factory, on that it's a business asset. On every business asset you get a depreciation. And once it is a depreciable asset, you have to follow this approach. Okay, now with this approach, what will be the right answer? Opening WDV. Look, this is the original cost minus debt. Debt means depreciation. After deducting depreciation for several years, you will have to find WDV. WDV, you know how to find? Cut depreciation. Starting from 1819. And look, why do you cut? Please understand the concept. Depreciation, you already enjoyed a deduction in income from business. So cut it. And after cutting, the balance cost will be counted in capital gains. Because imagine if you take full cost in capital gains, you are getting double deduction. Already on the cost you enjoy depreciation. Now that entire cost you want to minus as kawa. It is double deduction. So that's why this cost will be cut what? Depreciation and find WD. No need to find, but you understand, na? Yes, if you want to find what you have to do, you first minus 1819 depreciation. And in 1819 we have to see it is 3rd October, before 3rd October, after 3rd October, full year, half year. That full half concept is there or not? So 18, 19, 19, 20, 20, 21, 21, 22, 22, 23, 23, 24. That's it. Because we are in 24, 25. So for opening WE, you will cut till 23, 24. No need to do that. That will become your opening WDV. Then during the year, if you have purchased any more factory, add. Then if you have sold, see you have sold a factory. For how much? That you will minus. And then, we used to make a number column. And in number column, there is zero. No assets, no depreciation. And if in number column, there is one asset also. Yes, asset, yes, depreciation. And then, if all sold, positive balance, satak loss. Negative balance, satak chi. And some sold, positive balance, depreciation. Yes, asset, yes, depreciation. Negative balance, short-term gain. And under this system, it's always short. Because block of asset is a mixture of old and new asset. So since it becomes a mixed character, law presumes it as always short-term. Okay. So tell me when to do this thing then. Non-depreciable asset. Like if I have a gold at my home, my home gold is not a depreciable asset. So if I sell my gold, then this method, and then you see the life of the gold. If the gold is very old, long term. If the gold is not sold, short term. But here it can be short, long, depending upon the life. Because here you don't make block. Here you calculate asset-wise capital gains. In short, see, look, this method should be followed for non-depreciable asset. This is written in section 48. Then look here. This method should be followed for depreciable asset. This is written in section 50. Look at the summary. 48, 50, what is the name of the section? Mode means method of computation. See, I was discussing the method. First, I asked you to try. You used the wrong method. Your method, your mode was wrong. You are not wrong. You are very good students, but your method was wrong. So now I am teaching the right method. So tell me, where depreciable asset is there, what is the right method? WDV approach. And here it is always short term. And if it is a non-depreciable asset, the right method is FVOC, Kavva Kavvi, I Kavva I Kavvi, and here it is short, long, anything, depending upon the period. Okay. Tell me, non-depreciable, many examples are there. Jewelry, shares, here, land, residential house. Okay, if you understood the concept, tell me the real life question answer. This projector, if I sell, what will happen if I sell this projector? Will I follow this method? No, for a coaching class, projector is a used in business. An asset used in business depreciation. So it's a depreciable asset. So I will follow this method. In fact, in the block of projector, there is camera also, air condition also, because all are subject to 15% depreciation and all similar rate depreciation are grouped together. So tell me, if I sell the projector, effect will come in block, you will minus. Okay. See, actually, this knowledge you already had. I just made it clear with section. So 48, 50 is for the namesake a new section. But you already had the knowledge of this. Okay. See what we finished here. This ESOPS section is also over. 48, 50 is also over. Okay. Then look at this. Next I am taking this one. Section 50B. Very important section. This is on slump sale. For some time you think, what is this slump sale? I know you don't know, but sometimes with the words, you should guess the meaning. Slump sale. Section is what? 50 capital B. And see, when I write 50B without a bracket, so it is without a bracket. Many students, write like this 50 and then they put their own bracket only. Don't put the bracket if there is no bracket. See, bracket means it becomes a subsection. 50 becomes the main. Bracket B means the in section 50 point number B. But the main section itself is 50B. So don't put it in bracket. Huh? Okay, think what is slump sale? See here, slump sale is the sale of a business. But when it is called slump sale, I will tell you. Tell me one general question which everyone should be able to answer. Tell me today, if I sell my business, how will I charge the price? For example, I want to sell my coaching class. I want to sell my whole coaching class. Obviously, will I give it for free? Obviously not free. I want money. Although I don't want to continue the class, but I have got benches, camera, projector, so many things are there. So tell me, if I sell my coaching class business, how will I do the pricing? I will see in my classes there is a camera, there is a projector, there is air condition, okay, there are benches. So for each asset, I will asset in the market value. And by adding the market value of each and every asset, I will total up the value and then minus all liabilities. Because in my coaching class business, there might be some creditors to whom I have to pay. There is some outstanding staff salary which I might have to pay. So that liability I will deduct. So this is the way you do the pricing. So see, I have just drawn one template here. Generally, this way you calculate the price. So assume in my coaching class there is a land, building, machinery, stock, data. This is just a random example. So I will add the market value of each and then minus all the liabilities. Then this will be my purchase consideration. Do you agree? This is the way you do the pricing? But sometimes the deal happens in a different way. You know what I will do? I will sell my coaching class to someone without adding the market value of each and every asset. I will tell someone, you take my coaching class, give me 1 crore. Take everything. Take my benches, take this table, take my computer, take my camera, take everything. Just give me 1 crore. How did I get 1 crore? Random. But just for example, 1 crore, okay. So I am charging 1 crore, but what was the base? Did I add market value of projector, market value AC? It is without adding the individual asset value. I quoted the price in lump sum. in lump sum. And when a business is sold for a lump sum price, it's called slump sale. Lump sum, slump, lump sum. Slump, slump, slump. You're not getting the feeling of lump sum and slump. So the word slump sale is what when a business is sold in lump sum manner. See, you might be wondering, sir, how did you sell the whole coaching class for 1 crore? What was the base? It is my property, it's my class. I know its value very well. Like, see, this is my phone. I know the phone. How I know what is the defect in the phone, whether it is good or bad model. I know very well. So I can do the pricing. So similarly, I own my coaching class and I am doing the business in so many years. So at least I am that much expert. I can say take everything for 1 crore. And I am not a fool also that I will give it for a throwaway price. I might have charged a good amount. But the basis of charging was not add individual asset, lump sum price. That is slump sale. Now, to take it further, I will take one example. Because with example only I can move further now. Let's assume X Limited is a big company. See, why I'm taking this example, you see any past paper or study material question, they have given question like this only. Because see, if I continue my coaching class example, I can explain. But in this study material and past paper, you will find example like this. So, understood the concept. Now, let's take this example. Assume X Limited is a big company. It has got 3 divisions. You understand 3 divisions means what? 3 departments or 3 lines of business. Means assume in my example, division A is in textiles. Division B is in chemical business. Division C, information technology. In short, company is one, but they've got 3 business. We call these are 3 units, or we call these are 3 undertakings. See, be familiar with these words, because in the exam, they will use such words only. So tell me in proper English, X Limited has 3 units or 3 undertakings. In simple language, they have got 3 varieties of business. Okay. Now you know what happened? They are fed up. They are fed up of division C. They felt this division C is continuously making loss. I don't want to carry on this business. I will carry on my business A, business B. And they want to sell business C. And there was one company of Z Limited who is ready to acquire the business. So I told them, you take away everything, give me 1 crore. So what is 1 crore lump sum price? Now tell me, in slump sale, what is the main problem? How will you calculate capital gains now? Because in slump sale, have you sold one asset or so many assets? Like when I sell my coaching class, what have I sold? My benches, my camera, my projector, my air condition. So it is one item sold or so many things sold. And generally, capital gains is asset wise. But here, capital gain asset wise calculation not possible. Why? Because I don't know the asset wise price. My price of 1 crore is asset wise or lump sum. So because I do not know asset wise price, I cannot do the calculation asset wise. That is the difficulty over here. See, person who did the deal, he did the deal in a minute. Take everything, give me 1 crore. So deal happened very fast. But when it comes to capital gain, we will be stuck up. Like see, imagine in my division C, these are the assets. And capital gains, we want to calculate asset wise. So tell me, if you want to calculate capital gains for land, how will you calculate? You will take FEOC. So what will be in FEOC? Question mark. Will you take 1 crore? 1 crore is for the whole business. It's not for land. So if I don't know the FEOC only, I will be stuck up. Then for building and machinery, they are depreciable asset. They are So I want to follow this approach. Opening WDV, add purchase, less sales. How will I get the sales? Will I take 1 crore? 1 crore is for the whole business. But I am calculating building and machinery. In short, okay, stock and debtors will anyways not come in capital gains. For stock and debtors, business income will arise. Stock means goods, debtors are receivable. So these will come in business income. But to measure business income also, I should know that for stock how much I am getting. 1 crore is for the whole business. So in short, your main problem you understood or not, asset was working is not possible. That is why section 50B says forget asset wise. Forget it. Drop the idea of asset wise. Assume the whole business C is one single item, one asset, and make only one calculation. Because the pricing is done in single, computation should be also single. Pricing was asset wise or single? Single lump sum. So computation also should be single lump sum. Now tell me how will you calculate one single calculation? See, I've kept ready. You tell me the amounts. Read what I've written. Computation of capital gains in which entire division C is treated as one single capital asset. See, this is weird. Actually, in a business, there are so many assets. But then what to do? Asset-wise computation is not working. So we are left with no choice but to do a single computation. Okay, now the amounts are simple. Tell me fast. FEOC, 1 crore. What is the full form FEOC? Full value of consideration. Consideration means something in return. So tell me your business C has gone. In return you have received 1 crore. So 1 crore is FEOC. Transfer expense, ignore, nothing is not. Let's assume nothing is there. There might be some agent also, middleman, who has cracked the deal. So if it is there, you will minus, but not there. Then net consideration. Now tell me, at this stage you have to think what you know, whether it is short or long. If it is short, I will write kawwa. If it is long, and if it is before budget, index kawwa. And if it is long, after budget, only kawwa. So first decide short or long. You will have to see the date of commencement of business C. Many students say date of incorporation. See, on incorporation, X Limited was formed. And it is not necessary at the time of incorporation, division C was started. See, sometimes when you form the company, at that time you have got only one business, business A. And business C was later on added. So you don't have to see incorporation date. Incorporation date is the happy birthday of the company. I don't want to see the happy birthday of the company. I want to see the happy birthday of division C. So when was division C started? That will be given in the question. So let's assume this division C we are running since 20 years. Look at this. Read, I have written 20 years. So it will be long term. So if it is long term, what should I write? And assume it is before budget. Huh? Index cover should come. And wait, it is long term. So I will cut this Satakji. Correct? Because in my example it is long term because of 20 years. Now, index cover. You know, in slump sale, look, indexation is not allowed. Even if it is before budget. See, generally what rule we have said, if long-term things are there, before 23rd July 2024, we do indexation. On or after 23rd July, we don't do indexation. But for slump sale, whether before budget, after budget, indexation is not allowed. You should know why. But I cannot explain the logic now. First, I will have to decide what will come in kawwa. Unless I explain the kawwa, means cost of acquisition, I cannot explain why no indexation. So for that, please have some patience. But this is a point to be understood. Why no indexation? Sir is saying even if it is before budget, still no indexation. Why? I will explain. First tell me what will be the cost here. See, cost is interesting. See, look here. When I am selling some gold, so I will write the cost of the gold in the calculation. If I sell shares, I will write the cost of the shares. So here what I am selling, gold, shares or a business. I am selling business. So if you are selling business, write the cost of the business. And cost of the business is net worth. So here you will have to calculate net worth of division C. See, actually cost is of that what we are selling. Today if I sell gold, I am interested in writing cost of the gold. But here I am not selling gold, I am selling my whole business. So I want to know the cost of the whole business, which is nothing but net worth. But now how to calculate net worth? Don't think you know net worth. Huh? What you study in accounts, please keep it aloof. Huh? I am tax man. Taxation has got different rule only, okay? So here you will have to calculate net worth. So ask me how to calculate net worth. Ask then. Okay, you want to know how to calculate net worth? See, they will give a balance sheet in the question. In balance sheet, they might give you details about division A, division B, division C. Ignore division A, ignore division B. Focus on division C. So let's assume this is division C balance sheet only. Yeah? From balance sheet, you will ignore certain items. So see in balance sheet, share capital, reserves and surplus, miscellaneous expenditure. Completely ignore it. What did I say? Share capital, reserves and surplus, miscellaneous expenditure, ignore it. Other than that, add all assets minus all liabilities. Everything you have to plus and minus. Plus all assets, minus all liabilities. But what you will ignore? Share capital, reserves and surplus, miscellaneous expenditure. Miscellaneous expenditure. These are shareholders' fund. Anyway, these are neither asset nor liability. Rest all asset minus liability, and at what value? Everything at book value, book value, book value. What is this BV? Book, everything at book value. But depreciable asset should be taken WDV as per income tax. See in the balance sheet there are some depreciable assets like machinery. See machinery, the balance sheet figure will be wrong because balance sheet is made by accounts man, and accounts man they provide depreciation as per their own style, and we want as per tax man. And taxation people have a different rule only for depreciation. So that's why assets which are depreciable, we will take the WDV as per income tax, and that will be given in the additional information. See in the balance sheet they will give, but that will be accounting WDV. But you will ignore that. You will take WDV as per tax which will be given in additional information. Okay. So only this thing you have to be careful. Rest all assets, book value, book value, book value, book value, book value. Liabilities also, book value, book value, book value. Everything at book value. And then all assets minus liability will become my net worth. Now let's assume the net worth comes to 80 lakhs. I am not calculating because soon I will take one question. There we will see how to do. Right now we just understand theoretically. And let's assume we got 80 lakhs. Don't wonder how did I get. It's a random figure. Assume I got 80 lakhs. So now what is the answer? 20 lakhs. This is long-term gain. Now the doubt is, why no indexation, sir? Why no indexation? 80 lakhs you understood, na? It is all assets minus liabilities. And everything at book value except depreciable asset, there you will take WDV as per income tax. Net worth is calculated asset wise. See, her reason is what? We are doing the pricing in lump sum. See, pricing is come in FEOC. Indexation is for the kawa. Kawa is net worth. Net worth is calculated singly or asset wise. How did right now only I told you net worth how to find all asset individually add book value book value book value book value. So net worth is asset wise. So why now see without hearing only I am saying now some students have got the reason what sir balance sheet which we take it is a latest balance sheet correct. The balance sheet which we take for the purpose of net worth, it's the latest balance sheet. But even though the balance sheet is latest, the figure inside are historical. Accounts follows historical accounting. I don't know how much you know about accounts, but in accounts, although we write balance sheet as on current date, the figures inside are history. Like see, if a company has purchased land for 1 lakh 50 years back, so even in today's balance sheet, it will appear 1 lakh. So if someone says, then why do we write balance sheet as on current date? See, current date means at present, the assets which we are having, the disclosing. But the values are historical. And historical means it's a very old generation price. So it should be indexed. But government says no. Let's assume net worth we calculated from here. We took land, building, machinery. Tell me here what is the rule? Depreciable assets will be taken at WDV as per income tax. Rest all will be taken at book value. So tell me, when you take land, in the balance sheet, land will be at historical value. So we should do indexation. Yes, building and machinery, they are block of asset item. For them, anyways, indexation is not allowed. In income from business, block of asset, there is no in long term. See this. Today only I taught you. Under this concept, there is anyways no indexation concept. In my example, this concept is applicable for building and machinery. So building and machinery, we understand there will be no indexation. But at least land deserves indexation. And at least for land, government should give indexation. But government says no, no indexation. First tell me, when government says no for indexation, you feel good or you feel bad? You feel bad. Why? Because indexation will increase your cost. It will make your cost big. And big cost you minus your gain become chota, your tax become chota. But if government says no indexation, so your cost will remain small only. So small deduction will give big gain, big tax. So when index is not allowed, you are feeling bad. And you will argue also with government. It is very bad. We want indexation. You know what government will say? Instead of crying, be grateful for what you know. That you are getting the character of long term. In slump sale, there is one hidden advantage. Because we are calculating the capital gains for the whole business, we see the life of the business. And since the life is 20 years, the entire business got the tag of long term. Imagine if you would have done capital gain asset wise. Just imagine if you would have done capital gain asset wise, like for land, building, machine, asset wise. So many assets would have resulted in short term. And on short term, the tax rate is horrible. Short term is subject to slab rates. In slab, you can go to 30% also. But feel lucky that we didn't go asset wise. We saw the business is 20 years old. The whole business got the character of long. And long term character is beneficial because the tax will be less. Before budget it was 20, now it is 12.5. So already you are getting an advantage in slump sale. Then don't be so greedy for indexation. This is the logic. Okay. See, do you agree with one thing? If there was no slump sale, if it was a normal sale, then I would have done capital gains asset wise. Asset wise, how will you do? Tell me. Just tell me first. On land, take this example. Land, full value consideration, cover. If short, long, anything. Then for building and machinery, always short term, depreciable asset. Stock and debtors would have come in business income. The asset wise working, stock and debtors will not be taken in capital gain. It will go to business income because stock means goods. And in business income, the tax is slab rates only. So imagine your tax would have been high if the working would have gone asset wise. But law says feel lucky because you did slump sale. We are not doing asset wise. We are doing the calculation for the business as a whole. And your business, because it is 20 years, everything became long. Whereas in the business, many items are short only. Like see, if you see this coaching class might be old. Projector was purchased yesterday only. Means in a old business also, the assets are recently purchased. So if recent asset purchased and sold, the gain could be short term. But government is not seeing all that. What is inside the business, forget. The business is 20 years old, long term. So in short, already there is an advantage. That's why people do tax planning. Whenever a businessman is selling the business, he would prefer slum sale. You know why slums? Actually, anything can be beneficial. See, slum sale looks beneficial, but the disadvantage is indexation is not there. But generally, slum sale is preferred. Why? Because if you don't do, like, see, if I also want to sell my coaching class, I will prefer slum sale. Because if I do asset wise, this camera, projector, air condition, everything will be short term. Because they are depreciable asset. And in depreciable asset, opening WDV ad purchase, it will result in short, and short term has a heavy tax rate. But what will I do? I will do slum sale only. And my coaching class running till 2007. So I will get the character long term. So long term the tax will be less. So already the advantage is there. That's why no indexation. Tell me, how did I calculate net worth? Yeah, in long term capital gains before budget, 20%. After budget, 12.5%. Yes. See, long term tax is always less. Tell me, tax on long is less or short? Long. Short term capital gain, don't remember that Satakji under 111. That is equity shares. Here it is sale of equity shares of business. Business. Okay. So tell me, generally short term is taxed at what? Slab rates. And in slab rates, it can go till 30%. And generally, this slump sale, all that happens with big companies. And companies have to pay flat 30% tax. The tax rate for company? 30%. So short term is taxed as a regular rate, which is big. But long term, before budget it was 20. 20 was also less. After budget it is still less. 12.5. Okay. So long term is beneficial. Okay, see, I was asking, how do you calculate net worth? Repeat, I want to explain some more points. From balance sheet to take everything at book value except depreciable asset, you take WDV as per tax. Okay. Now, if in the balance sheet there are 35 AD asset, then take nil value. Because 35 AD asset in income tax, they are fully written off. In 35 AD, what we do? 35 AD cold chain, warehousing, cross country, hospital, hotel, housing. In that you get full cost reduction. So in income tax, when full cost is allowed, so it is fully written off. So WDV should be nil. So see, it is understood, but law is clarified that if in your balance sheet there are 35 AD assets, see, accounts people, even for 35 AD, they provide depreciation. Huh? But for taxman, 35 AD means nil value. So if in the balance sheet there is 35 AD asset, take nil value. One more thing. If in the balance sheet there are self-generated assets, self-generated, which are generated on your own, like your Google, so take nil value. Now you will argue, sir, self-generated assets, self-generated goodwill, anyways we don't record in accounts. You know, in partnership accounts you were taught goodwill is recorded only if it is purchased goodwill. But the goodwill which you generate, your own reputation, by hard work when you generate, it is a self-generated. Anyways, it doesn't appear in balance sheet. But what law is trying to give you warning, you know, if you are recorded in the balance sheet, we will take it as nil. Because we feel self-generated assets should be at zero value. Because the asset which you have generated on your own, it has not involved any cost. So it should be taken nil. So see, certain things in network that I said, 35 AD asset take nil. Self-generated asset take nil. One more point. You know, people can do cheating in net worth. There is one idea of cheating. Don't become cheater in life, but you should know the cheating. Otherwise, people will fool you. So tell me, what cheating can be done here in net worth if you want to avoid the tax? See, in the balance sheet, tell me, how are you calculating net worth? Asset minus liability, everything you are taking at book value. Focus on the word book value. What a person will think, oh, book value means it is the value as per my books. He will revalue the asset. Like in my balance sheet, there are assets for 100 rupees. I will make it 500. I will revalue. And I will say, my books are like this only. Your law says book value. See my book. And in his book, what has he done? He has revalued. Revalue means changing the value. So assets which are of 100, he has made 500. You know why he's inflating? So that his net worth will become big. Then big deduction, your gain will become small. So this cheating is possible or not? But law says we are not a fool. Listen to a rule. If you revalue the asset, you revalue. We will not take the revalued figure. We will take the unrevalued figure. We will take the unrevalued figure. That means if some asset of 100, you made it 500, you keep it 500. But we will consider 100. Original value will be taken in net worth. See, this rule has to be made. Otherwise, people will get idea, oh, government is checking the book value. So, books of accounts are in my hands. I will revalue. So, revalued figure will not be taken. But see, whether revaluation was done in this year or anywhere in the past, if you have done revalue, whether it is upward or downward, we will take the unrevalued figure. See, don't think if 100 is made 500, then only. Even if 100 has been made 5 rupees, take 100. See, whether the revaluation goes upward or downward, what law says we don't want to see revalued figure. Neither the value goes up nor the value going down. We will see the pure original value, which is unrevalued, untouched value. Historical value. Okay. Look at this. Net worth in a better manner. Net worth only. Tell me, here with the help of a small balance sheet, I was struggling. Many things I was saying orally only. Now everything is written here. So tell me, summary, nothing new, repetition. What will you do? Depreciable assets you will take WDV as per tax. 35 AD asset nil. Self-generated asset nil. All other assets book value. And book value should be unrevalued, untouched, not the revalued. Outside liabilities book value. What to ignore? Share capital, reserves and miscellaneous. Okay. One last point, then the theory is over. Huh? See, tell me, in this 1 crore also some cheating is possible. See, net worth, what cheating people can do, I told you, no? They can revalue and inflate the net worth. So that I explained. Here also people can do cheating. There are many cheaters in India. No one likes to pay tax in India. Tell me here what cheating is possible. Correct? You know what I will do? I will tell someone, take my whole coaching class. And actually, I am selling my business for 5 crores. But I am telling him, give me in check only 1 crore. Balance you give me in cash. Because if you give me in cash, I will hide it. No one will come to know. What will be official? The check amount. 1 crore. So even if they are selling the business for 5 crores, they will show only 1 crore. So to reduce the tax. So here also cheating is possible. But law says we are not a fool. Listen to a rule. If you show you have sold the business for 1 crore, we will not trust it. We will not trust it. We will find out what should have been the value of your business. At what price you should have sold the business. So you are showing I sold for 1 crore, I sold for 1 crore. You are a liar. You are a big liar. We don't trust you. So government will estimate what should have been the price of my business. And how to estimate what should have been the price of my business? There are detailed rules not in the syllabus. This is a big theory which I explain in final CA in detail. And in current CA final paper, they had asked a slump sale question only. This thing is there in CA final also, and even you have in CA inter. Okay. But just sharing in the recent paper only, they had asked slump sale question. But in final CA, you will also have to estimate what should have been the real value of your business. Because see, 1 crore is not trustworthy. I told you what people do. They take less amount in check and they show I have sold a business for this price only. In fact, the sale is at a big price. And that big price government will have to find out by doing the valuation of the business. And that valuation is done by Rule 11 UAE. UAE, Dubai. What is UAE? United Arab Emirates. Just to remember, huh? So in the law there is rule, repeat, rule 11 UAE. That explains how to find out the true value of the business. Because 1 crore is not trustworthy. Okay, tell me, as per rule 11 UAE, the true value of the business is say 6 crores. Then government will say, liar, you are saying 1 crore, what? Not 1 crore, pay tax on 6 crores. How did I get 6 crores? As per rule 11 UAE. And that mechanism of calculation is not kept in the syllabus. You know what they do in CA Inter? They directly give the value. Value as per rule 11 UAE 6 crores. So what do you take? 6 crores. Okay, tell me what if it is like this? As per rule 11 UAE, the value comes 92 lakhs. Then you are an honest person. Because as per rule 11 UAE, it is only 92 lakhs. But you are saying 1 crore. You are honest. Pay tax on 1 crore. Means it is whichever is higher. Whichever is higher. Look at the screen. Whichever is higher. Either you take FMB as per rule 11 UAE. For a CA Inter student will be given. And compare with the actual price. In my example, actual price is 1 crore. And then whichever is higher. That means, see, if your actual price is higher, then no problem. But if you are showing small, chota, then ignore actual price. We will take FMB as per rule 11 UAE. In short, whichever is higher. So see, actually at inter level, this is not a tension. But in my final CA batch, you know what I say? This is tension number 1. This is tension number 2. In the sums, what is tension number 2? Net worth. See, this is also a typical calculation. Although I have made it crystal clear, after this you will never find it wrong. But people find this also complicated. So this is one important working which is there in CA Inter. But actually this is one more working which is actually challenging. But for final CA student, for you it will be given ready-made. So that's it. Slump sale is over. Slump sale is over. Okay.